Welcome everyone to this event on Prudential Net Zero Transition Plans, extending the supervisory time horizon through transition plans. My name is Ulrich Volz. I'm a professor of economics at SOAS University of London. We're also direct the Center for Sustainable Finance. And I'm also a visiting professor at the Grantham Institute at the LSE. And it's my great pleasure and honor to welcome you all to this event, and in particular, welcome our wonderful panelists who are sharing their precious time with us. And so we have 1 hour, and we will first hear a presentation by Professors Agnieszka Smoleńska from the Polish Academy of Sciences and Professor Jens van Klooster from the University of Amsterdam, who have co-authored a new report together with our colleagues Simon Dickau and Nick Robbins at the LSE, and also myself. And this report, as you well figured out, is on net zero transition plans. And in fact, it's not brand new. This is the launch event, but we actually published it in November at the COP to feed into these discussions. And so we'll first have a presentation by Agnieszka and Jens for around 10 minutes, and then we will have some responses, comments, thoughts from a wonderful panel. And on the panel, we have Anuschka Hilke, who's Program Director for Financial Institutions at I4CE, that's the Institut de l'économie pour le climat. So I'm trying to practice my French here. Then we have also with us Robert Patalano, who's a senior counselor at the OECD, and until recently he headed the OECD's financial markets division. Then we also have Laurent Clerc, who's Director for Research and Risk Analysis at the French Prudential Control Authority, ACPR. And then we have another Frenchman, but who will join us, or who's joining us from Berlin, Morgan Desprez, who's Executive Director for International Climate Finance, Land Use and Net Zero Macroeconomy at the European Climate Foundation. And many of you will also know him as long-term head of the NGFS Secretariat at Banque de France. So we have an excellent cast of speakers, and we have an excellent topic. And I think, and I'm very biased in that, we have an excellent report, and Agnieszka and Jens will give us the key messages, and then we'll dive into the discussion. And all participants are very much encouraged to use the Q&A function. So put your questions in there. You can also vote for kind of the top questions that you want to have answered. Please add your details so that we know who's asking. And yeah, so let's have a lively discussion, and I hand over to Agnieszka and Jens.
Okay, so hello everyone. Just 1 second as we
have slides. Yeah, amazing. Okay, yeah. Thank you all for being here. Agnieszka and I will present the paper together and change back and forth on the slides for different aspects of the report. So the idea is to give you a brief overview of the main findings of the report, net zero transition plans, Prudential playbook for supervisory authorities. So since the signing of the Paris Agreement, central bankers, regulators, supervisors, and other policymakers have been working really hard to make financial flows consistent with a pathway towards greenhouse gas emissions, low greenhouse gas emissions, and climate resilient development. At the same time, it's become increasingly clear that climate change is a source of financial risk. It exposes financial institutions to material risk, and these fall clearly within the scope of supervisors. However, the current focus, the current way in which we do supervision, focused on quantifiable risks, is not always adequate for capturing the specific risks that climate change raises for financial institutions. The issue is really well illustrated by the chart on the right. The International Energy Agency has consistently for the past years underestimated how quick solar energy would be deployed. And again, this year, solar energy has exploded way much faster than expected. And because it's very hard how fast these sort of new technologies of decarbonization evolve, how policies evolve, how different industries interact with each other, financial institutions are exposed to all these really hard to evaluate risks. This means that backward-looking methodologies, which measure risk based on the past, are inadequate. And it means that instead we need forward-looking methodologies, which focus on the future and the ways in which the bank's operations are aligned with plausible pathways for the transition. Now, one of these approaches that we're very enthusiastic about and we're writing on are Prudential transition plans. And this is also a discussion that's currently underway. There are adequate legislative proposals that give supervisors a basis to act. And we want to provide a playbook that gives supervisors a way forward. Agnieszka. Shall I put up the slides? Okay, there seems to be
I think Agnieszka is frozen.
on Agnieszka's side, right? So I just continue with the presentation.
Yeah, that's.
Oh no,
Agnieszka is coming back now.
there you are.
But the slides are not uploaded right now.
Yeah. Sorry about this. So I jumped straight to the three types of transition plans that we have.
Can you do full screen instead of sharing the?
Can't you see this now as a full
Well, we can
screen?
see the next slide.
Yes.
Yeah, that's perfect now.
It work? Okay, so sorry about the technical glitch there. So in our report, we distinguish different transition plans. And just to recap, transition plans are the documents that outline how a particular institution intends to align with its strategy and its operations with Paris Agreement. So we distinguish three: voluntary, mandatory corporate transition plans, and prudential transition plans. Now, these different documents differ in a number of important respects. Their aims and scopes, the sectoral coverage, so whether they are for all corporates or only banks or only certain types of financial institutions, the nature of the requirement, whether it's mandatory or voluntary, the perspective, time horizon, the role of respective supervisors, so whether we are thinking about the market conduct or banking supervisors, who are the standard setters, and the level of transparency, so whether these documents are being public or not. And these different types of transition plans have very different weaknesses and strengths, as we discuss. So voluntary plans are developed in the context of global initiatives such as GFANs. They have clear benefits in terms of being relatively flexible, allowing for significant ownership by banking institutions, so a clear commitment. But at the same time, as we know from the discussions around GFANs that have been ongoing, nothing stops banks from stepping back on their commitments. So they can make pledges, but these pledges can be revoked. Now, mandatory corporate transition plans, such as the ones that are currently introduced in the EU in the context of CSRD and the EFRAG standards, allow for consistency across different forms of corporate activity. However, they are not risk-based, and as such, they are a little bit further from maybe uncertainty between the respective responsibilities of different authorities. And finally, Prudential transition plans are focused squarely on the safety and soundness of banking institutions with respect to climate and environmental risks, and those that follow specifically from the misalignment of the business strategy organization of the bank with respect to the sustainability transition as defined by policymakers. There seem to be.
Agnieszka, you're cutting in and out.
Yeah. Okay, I'll just leave it with Jens. Is Jens here?
Jens?
Yeah, I am here.
Yeah. Do you want to take it further?
Yeah, so I take it further. Agnieszka has to stop sharing her screen so that I could. Okay, yeah. So we've seen that there are these different kinds of transition plans. We've seen that merely voluntary, but also these market-focused corporate transition plans really don't give supervisors distinct prudential perspectives. Why do we think this specific prudential perspective is required? We think that the core issues of banking supervisors, these really traditional risk categories, credit, market risk, when it comes to climate and environment, have a number of features that have eluded existing supervisory frameworks. Longer time horizons, risks that can materialize over longer periods of time, complexity, developments in one sector impact developments elsewhere, how the energy sector decarbonizes has impact throughout manufacturing sector, and then as we saw, the limited effectiveness of backward-looking risk management approaches, risks that have not materialized so far, and across all these fields still persistent lack of the right type of data, both concerning where firms are and what the technological possibilities are for decarbonizations. Now, we think in this context, supervision focused on assessing transition plans of financial institutions, seeing how their plans fit with credible transition scenarios, can complement forward-looking scenario analysis and stress testing, and providing better insights into the risks that institutions are exposed to. Okay, so there are, we think, three distinct ways in which prudential transition plans could have a really important role in the supervisory process. First, we think that asking financial institutions to develop these plans already gives supervisors a heuristic, a way of looking at their current balance sheet on the currently relevant time horizons, where significant exposures may stand out. Where it becomes possible to zoom in on specific aspects of the balance sheet and risks that the institution is exposed to. We think, and more ambitiously and more innovatively, that prudential supervision could focus on alignment as a proxy for assessing a bank's exposure to long-term risks. So an institution that doesn't have a credible and effective transition plan, ceteris paribus, is more exposed to risks going forward. And this is an alternative to measuring risks that elude existing methodologies. And third, we think that having transition plans of all these individual institutions together collectively also provides insight into risk that the banking system as a whole is exposed to, and in that context could have an important macro-prudential role.
So our report is a playbook for supervisors. We specifically focus on the elements of what it would take for prudential transition plans to be fit for purpose. This entails having the right expectations from the supervisor, the right assessment of such prudential plans at micro and macro level, and also there needs to be a specific consequences relating to either corrective measures that can be used by supervisors, including potentially different types of additional capital requirements. For the sake of time, I move to the final slide. I hope this is the part that we could also come back to in the discussion. The takeaway from our report is fourfold. First, there is an urgent need to get the transition plans right in the context of flurry of legislative activity. So we discussed the different plans on the table. There is a need and to be mindful of the need to ensure consistency of supervisory approaches across the corporate disclosure and bank-specific disclosures in particular, and the regulatory requirements at the level of individual jurisdictions, but also globally, so within the Basel Committee, FSB, and GFS. Now, where a bulk of transition plans will be developed by large cross-border groups active across the globe, it is important to think about cross-border cooperation. Secondly, cross-sectoral cooperation, so micro and macro supervisors, market conduct, banking supervision, but as well cross-discipline. Prudential transition plans are a risk-based instrument, but they are very much anchored in broader non-financial considerations. So we could imagine your environmental agencies, for example, being involved in the assessment of such plans. Now, the task of assessing transition plans is significant. It requires financial supervisors, banking supervisors to have access to capacities that are maybe not yet available to them, both in terms of resources and expertise. So this is something to be mindful of in this discussion. And finally, given the importance of ensuring the alignment of capital flows with the Paris Agreement, ensuring legitimacy and accountability of the process of transition plans and their assessment, and anchoring them in broader socioeconomic transformations is something to be mindful of. Thank you for listening to the presentation. Apologies for the technical glitches, and very much looking forward to the discussion now.
Thank you so much, Agnieszka and Jens. And without further ado, I'll invite our panelists to chip in and give us their thoughts. And first, like to invite Anuschka, please.
Thank you very much. And I hope you hear me well. So thank you very much for this very interesting presentation. And actually, we were publishing exactly at the same time as this report was published, our own work, and we did this work actually quite in isolation, everyone on their own, but we actually came up with exactly the same recommendations, which is reassuring. We took a slightly different angle. We discussed with supervisors and financial institutions what could be the impact of the third option, really introducing prudential transition plans on banking, especially with regard to Europe, where the discussion maybe is a little bit further on integrating this, what we call double materiality, so integrating the question of aligning financial flows with the Paris Agreement and managing financial risks at the same time. And we found out that if really we take this broad scope covering, so integrating it fully into prudential risk management, having a broad scope covering all sectors, and ensuring this management of the double materiality, we can actually overcome a number of obstacles that banks are currently facing, especially those who have taken these voluntary initiatives and engagements, but who struggle today to actually put them in practice. So I'll run you very quickly through a few of kind of the key headlines that we found what could improve if we put in place these prudential transition plans for banks. So you already mentioned the impact on the tragedy of the horizons and the need to take a longer view. Obviously, this is one of the key aspects that this would be a solution to. And it would potentially be resolving the tensions that banks see today with participating in the financing of the transition today, and the risk-based approach as favored, as taken into traditional prudential risk management, because we need to admit that financing the transition today also comes with short-term financial risks, because nobody knows exactly where the transition is going, how it is going to unfold. So financing this transition also comes with short-term risk. So basically, if we simplify it, banks today have the choice of reducing short-term financial risks, but building up future financial risks because they don't finance transition, or dealing with short-term financial risks and probably reducing longer-term financial risks. So there is a problem here, and this is exactly why we do need prudential transition plans that can help banks to resolve this problem. It would also overcome a number of structural challenges, such as rethinking the structure and processes of banks, such as the business plan, but also internal structures and the internal incentives that have a strong impact on day-to-day decision making, on financing decisions. It could address also the significant human resources needs on bank level as well as on supervisor level, because it becomes officially part of prudential regulation, and it could have a very strong positive impact on collecting and handling the necessary data, because once this is clear that that banks need to worry about that, then supervisors can also develop expectations on what could be their role in gathering data, collecting data, centralizing it, and then using it. And there's also a number of other positive impacts that we could expect that are more about strengthening the credibility of bank commitments, such as guaranteeing a level playing field, developing the necessary internal procedures and indicators that are needed for that, ensuring that all banks actually implement their plans. And this is one of the big issues that we see with the current voluntary nature of transition plans. And obviously, and you talked already about the importance of consistency of different regulatory texts. So obviously there is a strong importance here of making making prudential transition plans consistent with other texts, especially in Europe, where we already have developed EFRAG standards. So it would be important to make sure this is not giving contradictory signals. I think I'd leave it at that for the moment, and then we can come back to that in the questions. Thank you very much.
Thank you very much, Anuschka, and I hand over to Robert.
Thank you, Ulrich, and let me thank the presenters as well for the excellent presentation. So look, I think we'll agree there has been a lot of insightful work at central banks, at international organizations, academia, but not enough genuine assessment on supervisory actions. And I think this paper is really important to bridge that gap and to really provide a structured approach to think about short-term micro, long-term micro, and macro PRU, and how transition plans are important for the second two, particularly for the macro side. Let me raise a few points here, and I was just jotting down as the presentation was going on. So I absolutely agree that using the transition plans for supervisory purposes, particularly getting beyond the short term to long term for micro and for macro PRU, are very important, but I would go even beyond the report in a few ways. I think it has several other important benefits beyond what you've said, and we can reflect on this. First, the transition plans will put more emphasis on banks getting the right data for scope 1, 2, and 3. And that has benefit across the industry. So whoever, whether you're an asset manager or an insurer, if banks are forcing the borrowers to really step up their own scope 1 and 2 availability, so banks can incorporate it into scope 3, everyone benefits in the system. That's really important. And even where there's voluntary reporting, required reporting by banks can improve voluntary reporting elsewhere. Second, I think taking a long-term perspective for micropru is advantageous in its own right, but it also allows for consideration of credit and liquidity risk through the cycle. And I think it's important to think about traditional cyclical issues and risks, particularly in credit, and then to think about directionally how losses, at least in the current environment, unless policies change, this is only going to get worse. So having supervisors think about the cyclical and this directional on climate and how to use micro and macro prudential tools, it's very complicated, and they're going to have to take this into account, not to mention biodiversity transition issues as well that they'll be needing to think about in the future. And then third, it provides benefits to strengthen insights into non-bank finance in a few ways. So if banks are providing this information to supervisors and supervisors are sharing perspectives in their financial stability councils within jurisdictions and across jurisdictions at the Financial Stability Board, that gives incentive for other regulators to better understand what they're seeing in banks and whether they're seeing the same things in their own realm, their own mandates. So this is going to help supervisors understand from a macro prudential and macro financial perspective the overall risks. So I think these are all really important, and it really has positive spillover effects to understand the transition, the pace of transition, the effectiveness of transition across the entire system. In terms of the use of macro-pru, I just wanted to highlight that I still think, I mean, this is a great step, but now we really need to think about what are the implications of using macro-prudential tools in an environment where you could have some contradictions. I think Anuschka had mentioned the tension between perhaps short-term micro, where you might face loss of profitability, for instance, if you're trying to invest more to have benefit over the medium term. But also we need to think about if you're using macro-prudential tools, let's say it's better risk management to reduce concentration, that could impose a higher cost of capital onto certain industries. I think that's good for market discipline. Maybe we want certain companies or certain industries to have to pay more if they're not making progress on the transition. But we have to raise the question of, does this lead to regulatory arbitrage? Are we bringing some of those risks into the less supervised or less transparent part of the system? Maybe funds, maybe CLOs, and we've already seen that traditionally in leveraged loans and CLOs, and that's traditional credit. And we know that that very same credit is being provided to high emitting industries or high emitting companies. And therefore we have to think from a systemic standpoint, are we just moving the risk to more opaque parts of the system? We have to prevent that from happening. And I think that the report's laid out a few tools, but I think we can build further to really try and map out how to do this so systemically it's a net benefit for the system in the short and medium term. Thank you, Ulrich.
Thanks, Robert. And over to Laurent.
Thank you. As I work in a supervisory authority, the usual disclaimer applies, so I will speak in my personal capacity. So first, I would like to thank you very much for the invitation and for the report, which I find very insightful. And I would say that I will share most of its conclusions. I particularly appreciated that you present a transition plan as a tool to manage financial risk, and that is exactly the remit of supervisors and macroprudential regulators. So that's a point. I'd like to make three kinds of remarks. The first is about the issue of transition risk for banks. When we are talking about transition, we are talking about greening the economy. So there are several ways forward, which are not exclusive. And that's why banks will face transition risk. Those ways forward are first to change the energy mix by raising the share of renewable energies. So it means, in a way, here financing innovation and green sectors. The second is obviously to improve the energy efficiency of the production of or the consumption even of emitting sectors. And there's a place here where banks will likely remain exposed to some of these sectors because, as you mentioned in the text, the abatement cost is too high or there's no alternative. So that's something that banks will still have on their balance sheets. The third is to reduce production and consumption. So for banks, it would mean, for instance, exit the financing of certain activities or divest from these activities. And the fourth way forward is probably to increase compensation, that is finance, for instance, carbon capture or carbon usage. And here again, there is the issue of financing the transition, the technology, etc. So this is why it's complicated for banks in this way forward, and why transition plans are important. Obviously, a transition plan have an objective. It's often stated as a final objective. So you recall in the paper that usually these are plans which are aligned with the Paris Agreement or net zero emission on the portfolio at the horizon of 2050, for instance. But the point is that because there is a lot of uncertainty also about the ability of the economy to change its energy mix or innovation to be there, banks are dealing with moving targets, and this is something which make the job complicated, but also increase their exposure to transition risk. You might have a plan where you envisage, for instance, to increase the share of renewable energies, but if the technology turns out not to be there, but you are stuck in financing things which have no future. So that's also something that needs to be taken into account. The last point I would like to make is that in your paper, you rightly emphasize on the concept of double materiality, which is a European approach. So saying that banks not only have to take into account the impact of climate change as a source of financial risk on their own business models or on their balance sheet, but also the impact of their loan activity on climate change. So I think that when you're talking about the issue of having a global approach, this is an area where there are still discussions because the remit of supervisors might differ across the board. I think one way to perhaps present it in a way which would make perhaps more consensus is to talk about the externalities. And I was struck by the fact that in the paper, the notion of externality is not mentioned. Here, I would like to make a parallel, which I think will speak to supervisors and central bankers, which is that in a way, transition risk is a bit like credit bubble risk. It means that if you do not take into account the externality, for instance, in a credit bubble, the banks keep on financing, say, the housing sector. But in doing that, it increases the risk of its portfolio. And when the market collapses, it's a big mess for the banking sector. It's exactly the same for transition risk. If you keep on financing sectors which are emitting a lot, and then by doing so, you are increasing the risk of your portfolio, it's likely that at some point you will face a downward revision and maybe stuck into stranded assets or whatever risk that you have to manage. So these are very important aspects, and I stop there for my first round of comment. Thanks a lot.
Thank you very much, Laurent. And last but not least, I'd like to invite Morgan to give his response.
Thank you, Ulrich. So thank you. I'll be brief as well in my first round of comments. I very much agree with the recommendations of the report and also with the comments made by my colleagues. Maybe 2 points. The first one is around this net zero financial sector. It seems to me that it doesn't exist. There is no net zero financial sector, but there might be one day a net zero economy. And so what we want to achieve is a net zero economy using, leveraging the financial sector to achieve that. And for that reason, I think it's important not to consider, but this is a little bit the sense of what you said, Agnieszka, this Prudential transition plan in isolation but we need to have a broader perspective and also take a look at the non-financial corporate world. In particular, here, I would like to mention a report of the United Nations Secretariat on the integrity on net zero commitments, which were published at Sharm el-Sheikh last year. And in there is a recommendation saying that there must be a sort of regulatory requirement to make sure that pledges to net zero from corporate are robust or actually followed up with real actions. So my point was to say, we have to think around also the regulatory framework that would be applicable to the non-financial sector and make sure that if we move forward on Prudential transition plan, we also move forward on the non-financial corporate side, simply because at the end of the day, but Laurent knows that better than me, banks have to go back to their clients, they need to understand their sectors. And so if there is no clarity for them, it's going to be difficult, I suggest, to have a credible Prudential transition plan. Second point I would like to make is about the point of resources. Agnieszka, you were saying that there is a need for supervisors to have the resources to assess the consistency and credibility of transition plan. You're right, and there is also an issue of benchmarks. It seems to me, but we can have the discussion that if you look around you, we have a lot of people, it's a pretty crowded space with a lot of initiatives going on, but I'm not so sure that we now have a level of maturity which gives us sufficient certainty that we have the proper methodology, the proper benchmark, to have a sectoral approach to transition pathways, and ultimately that could be translated into this Prudential transition plans. So all in all, and I'll stop there, it's of course great that we move towards Prudential transition plans. Important still to consider that in a broader perspective, also for the non-financial corporate world, and ultimately to reflect around the consolidation of benchmarks and methodologies to make sure that we have some areas where the supervisors could be comfortable and where they could rely on in their analysis.
Thank you very much, Morgan. And some of the points you just made are also somewhat echoed in a question that was put in the chat by Alex Lehmann. And he wrote, in the EU, there seems to be a political decision that transition plans will be limited to the largest companies only under CSRD, CSDD. Should this not limit the extent to which a bank with broad corporate and retail portfolio can be held accountable for a net zero goal? Methodology and measurement issues surely make this concept problematic, given the high standards applied to Pillar 1 prudential supervision. So I'll just throw that into the debate and would like first to invite Agnieszka and Jens to give some responses. I mean, pick whichever comments or questions you want to address, and the ones that you don't like, just ignore them. But yeah, Agnieszka?
Yeah, I'll go first, for keeping my fingers crossed that the internet functions smoothly. So I just wanted to pick up on 3 points relating to kind of redistributive impact of transition plans, the engagement with the real economy and how that functions, and maybe a little bit on this kind of institutional capacity and institutional discussion versus the benchmarks that are available out there, and kind of the institutional framework versus the toolbox that we have so far. So first on the points raised by Anuschka, and I really also like this in the I4CE report, kind of thinking about, okay, so we want this to happen, but what is the impact that this will have, for example, in real estate on vulnerable groups, if we have these transition plans that are requesting banks to have certain policies in real estate sector, for example. And I have to say that this was one of the things that in the context of our discussions about prudential transition plans, that if we have the risk-based perspective, this doesn't mean that you forget the redistributive impact, but it's acknowledging that maybe the redistributive part shouldn't be dealt with by financial supervisors. And I think in the transition plans, and this brings me to the question of engagement and real economy transition versus financial sector transition, clearly financial sector is leveraged, right, to accelerate the transition, but the prudential transition plan aspect is about trying to stay within this remit of risk-based, precisely not to overstep the different mandates that are out there, and also for legitimacy purposes, right? So these, some decisions maybe shouldn't be made in the insider world of the financial sector, but rather more broadly among the policymakers and with different institutions involved. And I think the engagement and the kind of scope of transition plans is an interesting example of this. So we have, yes, as Alex mentioned, the CSRD requires that those corporates that have transition plans disclose them, or else explain whether they plan to develop such plans. But when you look at the type of information that banks are going to be required to disclose under Pillar 3, for example, there banks are more granularly required already to disclose information about transition plan or transition alignment of different counterparties that they have. So actually, in a certain way, the bank regulations are already broader in that respect. That's, of course, you know, from the transformation and transition perspective, it's great. Here are all of these real economy firms that don't understand yet what CSRD is and what it will mean for them. But here, helpfully, banks will come and explain to them. Now, the question is, do we want the banks to set the terms of transition of the real economy fully, right? So how do we get this balance right? The efficiency of this idea of transition, of using the financial sector, while at the same time ensuring adequate adequate legitimacy of this process. And maybe I stop here but thank you very much for these. We are currently also working on further developing this report. So the comments are very helpful in that respect also. Thank you. I pass on to Jens.
Yeah, thanks a lot. And I think really good that we're all sort of on the same page with the importance of these transition plans. And I think also everybody has raised really important regards in which this project is currently not finished, right? This is really a very initial stage of looking at transition plans, finding ways in which this might work. I think Laurent has really nicely set out some of the limitations and open questions with regard to bank, also Morgan, on the specific, just really deep, difficult questions of developing these sectoral pathways. And I think one of the things we really want to do is to say, look, this is a process that should happen, that is going to happen, and there are all these things, and we should look at that. I wanted to focus specifically on this first, on this question of why banks. I think Robert also really nicely emphasized some of these aspects, right? These are such key actors in the economy that, particularly for smaller companies, the sort of corners of the economy that are in other ways really hard to reach, are really core actors. And there are also actors that can impose reporting requirements on all sorts of other actors in different ways. So in many ways, we think that really putting a lot of emphasis on this specific reporting requirement for banks will have all these positive spillover effects in the broader economy. I think also, and this has also been mentioned, this is a really good place for this learning access to take place, that by finding out a way in which you can effectively impose this requirement on banks, what kind of information you need, what sort of coordination between different policymakers you need, you really find a way of effectively aligning bank lending. And then I think it's just obviously true that will at some point involve some financing migrating to other corners of the financial system, and that's indeed then where other supervisors and regulators should pick up. And there are also sectors of the economy where investors have a lot of discretion in terms of the sort of risks they would like to take, and if there are investors who would really like to have all these core assets, that is also in some ways no longer a prudential concern, and there are other instruments. But I think, although of course there will be some spillover, really putting this requirement on banks and seeing how much you can get going there will have positive spillover effects on the broader economy and on broader prudential practices.
Thanks, Jens. I think the point about not going from 0 to 100 with transition plans is actually important. I mean, you obviously have to face these things in, and with, as we've seen with stress testing, kind of you start off relatively lightly, and before you have any direct implications, but you have to start somewhere. And let me just throw in a couple of questions. We've got quite a number of questions, and then I open the floor to all the panelists again. So we had a couple of comments from Mike Clark, who's founder director of Ario Advisory, and he had some questions regarding the NGFS scenarios, whether these are useful or not, and he doesn't seem to think they are particularly useful. Maybe someone wants to pick that up. Then we had a question by Andrew Wang from the European Commission, DG FISMA. You briefly mentioned macroprudential consequences in the form of systemic risk buffers. Do you see a role for other macroprudential tools such as borrower-based measures, concentration limits, etc.? And then we have Thomas Dietz from the Bundesbank. Let me allow to point out some practical problems, picking up some of Morgan's comments. If you go for prudential transition plans, what's the perfect benchmarking tool? PACTA, SBTI, Carbon for Finance. Who's going to decide on that? The supervisors doing on-site inspections, likely like they do for internal models at the moment, only for 8,000 banks instead of about 200. If not, who's supposed to determine it instead? And once we have such a decision, wouldn't we run the risk of seeing regulators creating exactly what they're supposed to contain, hurting behavior leading to financial instability? And then we have Stanislas Jourdan saying, which sectors do you think are easier or more challenging to start with? And I'll leave it at that. There are some more, and hand back to our panelists, and maybe we go in the same order as before with Anuschka, Robert, Laurent, and Morgan. Anuschka.
Yes, thank you. And maybe let me go back to the question on, do we have the right benchmarks? Which ones should we use? And I think we don't yet have the right one. But that doesn't necessarily doesn't mean we cannot put in place prudential transition plans as yet. So in my view, the interesting part of putting in place prudential transition plans is that the regulators can, or the supervisors can then think of which is the best trajectory to actually put them in place and ask for their implementation. And obviously, the first point where they need to start is the building up of data and the right benchmarks. So, but that gives then the supervisors the power to actually mobilize the financial sector to developing, let's say, tools that are better placed than what we have today, because we do have these alignment assessment tools, but and I totally agree with the point is not to start to motivate banks to heavily divest in one area and then invest in another area, because while banks can probably quickly start shifting their portfolios, the economy is not moving maybe just as fast. So what we want banks to do, we want to finance the transition of existing actors. We don't want them to necessarily divest. We want them to push actors to move. So in that way, we are getting the financial sector moving at the same pace as the real economy, or said differently, we get the financial sector to push the real economy to move faster. So, but we don't have the right metrics for that. The alignment metrics, portfolio alignment metrics, are not really delivering on that. So there is more to do, better metrics to be developed, and we need the financial sector and the supervisors and the think tanks and academy, everyone on board to understand which are the best metrics to do that. And putting in place financial transition plans can be the start of that discussion.
Thank you. Robert, over to you.
Sure, thank you. So one of the questioners had mentioned the use of certain tools. So, you know, beyond having a direct impact on capital, you could think about concentration limits, you could think about different forms of risk management, you could even think about the use of engagement strategies that banks would provide or engage in with their key lenders as being part of that. And really, engagement strategies combined with concentration limits could be considered an extension of the supervisory power. So if the supervisor is overseeing, I think you can look at the Basel Committee has just come out with principles for climate risk management, and they mention concentration and engagement. So if you're telling a bank that they need to reduce a certain concentration, over time, they're going to strengthen their engagement strategy to make sure that these borrowers are actually moving along the path on climate transition so that they don't have to actually reduce the amount of lending to these issuers or to these borrowers. I think that could be a useful combination. As well, we haven't really talked about it, but what is the right capital structure for industries that are taking more time to move down this path? Should we have it more equity-based? So if we're talking about risk to the financial system, presumably much of this is debt. We're talking about risk to banks, it's usually debt related. So should high-emitting industries or high-emitting companies be incentivized to actually shift to reduce their leverage, reduce their debt, take on more equity, and particularly in certain countries where equity markets are more robust, that could be an interesting path to actually reduce systemic risk as well. Presumably, there would be a higher cost of capital if you're deleveraging, but that higher cost of capital is the cost of doing business in an environment where there are higher risks, and that higher cost could incentivize firms to progress on their transition plans to be able to tap lower cost. But I do come back to the issue of where does that leave firms if they're not able to capture abundant equity markets? Do they turn to private equity? Do they turn to hedge funds or family offices and pay up even more for that access to capital? And what are the implications on that for economic growth, for resilience, et cetera? And then lastly, I would ask a question simply, how do we think about liquidity risk? If some of this risk is moving into funds, moving into alternative assets, do market regulators have the right tools in place to manage this? Should we have higher liquidity buffers? So right now there's talk about higher liquidity buffers for funds that have less liquid assets, leveraged loans, high yield corporates, et cetera. If you're layering on high emitting firms and you think there's transition risk that would reduce liquidity further due to forced selling, then you would want to incorporate that into asset management scenarios for liquidity. So there's a lot to think about here. We need to think about it holistically. We don't want to focus too much on banks or too much on leveraged non-bank finance, but think more about funds and other players, securitization, other actors in the system to make sure we're doing this in a comprehensive way. Thank you.
Thanks a lot, Robert. And over to Laurent. And so we have around 5 minutes left, so we need to
I'll
keep
be
it
brief. So perhaps I will react to two aspects. There was one question about the content of the transition plans, of what kind of objectives, etc. I would make perhaps a difference between a tiny difference between transition planning and transition plans. So if you consider that transition planning is the processes put in place by financial institutions to produce a transition plan, then typically this transition planning is can be already embedded into the supervisory process because it's part of Pillar 2, and as soon as you recognize that transition risk is a source of financial risk, you need to see whether the firm has put in place the adequate risk management framework, the adequate strategy, the adequate governance. So that is something that you can do. And then obviously about the content of a transition plan, it's probably too early to say, well, that's the good approach to take, but at least you can, as supervisors, put forward some expectations about what could be the content of those plans. So without necessarily pointing out to a very specific approach or methodology. So I think that's an important point. The other question, Robert already alluded to that, was about the choice of instruments. So in your paper, and I would agree that if you think of this risk as a macroprudential risk, sectoral risk buffer seems appropriate, but it's a capital tool. So it means that here you think you need to increase the level of capital as a response to manage this risk. There are alternative approaches, and it's fair to say that micro supervisors, like the BCBS, for instance, that you mentioned, would rather focus on aspects which are not yet captured in by the Basel framework, which are particularly related to concentration risk. So it might mean both sectoral concentration or geographical concentration. And as we have seen with the COVID, sometimes these two dimensions also are interrelated. So I think that this is something that is currently missing in the supervisory framework. I leave it there.
Thank you, Laurent, and over to you, Morgan.
That would be very quick. So as far as the toolbox is concerned, I agree with that we need to have many tools. Personally, I quite like the concentration limits. It seems to me that it could be quite useful. And I also very much agree with what Robert said about the risk of regulatory arbitrage and the shift of assets to private markets, where there is no public disclosure, no way to measure the risk. So yeah, I think, but it's something that Laurent and Rob knows very well. We have to be careful and make sure that it's not because we don't see the risks in the banking sector that the risk is not there. It could materialize elsewhere differently. So yeah, probably need to again have a broad scope beyond traditional plan for banks, but try also to see how to put in place a sort of monitoring and governance of that risk at large throughout various financial institutions.
Thank you so much, Morgan, and all the panelists. So I've got 2 minutes left for a wrap up, which is kind of difficult, but I just saw that Mike Clark posted in the chat that he noted that his NGFS scenarios question was ducked. My personal take on the NGFS scenario is that it's a starting point, but there's certainly much more work needed to develop better, more appropriate scenarios that are also much more country specific. I think the underlying macro model is maybe not ideally made for this, but that's my view. But I think what we can definitely take from this discourse, and maybe we also have a little bit of a non-representative sample of speakers here, but we all very much agree that transition plans are something that should be taken forward. It's pretty obvious that we won't have transition plans overnight that will help really supervisors to do everything they would like to do or should be doing, but you have to start somewhere. And I think if we actually look at climate scenarios, you know, it's quite fascinating how much has happened in that space over the last couple of years. You know, the first scenarios developed by the DNB, stress testing analysis developed by the DNB, you know, that was very, you know, simplistic in many ways, and then we've come so much further. I think we're going to have some steep learning curves with transition plans as well, but we have to start somewhere, and I hope regulators will take this forward. Much more to discuss, but we'll continue working on the topic. In fact, tomorrow the author team will have a meeting to decide which directions we will go. There was one question in the chat on that. For now, let me just thank everyone for participating today. So thanks to all participants, but of course, a major thank you to our wonderful panelists. Sorry for not giving you more time to speak. but we definitely want to exchange with you going forward. And of course, thanks a lot to Agnieszka and Jens for presenting and answering questions. And thanks everyone, and have a great rest of the day. And let's keep in touch on this topic. Thank you.
Thank you. Bye-bye.
Thank you. Bye-bye.
Bye.
Thank you. Have a good day.